Okay, hello, good evening, everyone. Oh, that light doesn't work, does it? Let me just try a different light, see if that's any better. That's more natural. Hello, good evening, everyone.
Okay, hello, good evening, everyone.
And I'm echoing through my own iPad. So my name is Simon Misiewicz from Optimize Accountants. Thank you ever so much for joining me this evening. So we're going to be talking about property tax. Yay! So this is a few things that you can take some notes on. You can take some screenshots of what you're seeing in front of you. And yeah, let's just go through the slide presentation as I have it. Okay, so let's just make sure that this works. It does. So yes, indeed, my name is Simon Misiewicz from Optimize Accountants. I'm a UK and US qualified accountant. I specialize in real estate, property investments and tax, as well as business as well across the borders. So I'm really an investment focused accountant tax strategist, if you like. So it's all about building wealth whilst reducing your overall tax liabilities. Some etiquette for tonight's meeting or webinar. Microphones muted. I don't think you can actually have your microphones on unless you're invited to the show. So that one should be easy. The second one is ask questions at intervals. Now, you can ask questions. It's live chat. So the thing else I would say is that you can ask your questions as we go through, but what I'll probably do is answer them at certain intervals just to kind of go through those Q&A sections and keep them compact as well. And ask and you shall receive. Please, please, please do not sit there and think, oh, well, I'm not going to ask that question just yet, or I might wait till later on to ask that question, because by the time you get there, you've forgotten. Do you have that horrible sinking feeling where you think, oh, what was that question I was meant to ask? And then you don't until the webinar closes, and then you remember it. It's too late. So please, please, please do type in your questions as they come along. So the next thing I want to talk about is property tax basics. Now, what I'm going to try and do is see your questions as they come through. So if you could just say hi, then I know that the chat is certainly working on the chat box. I was trying to find where I can find the chat as well. So I'm going to try and do that. So if I could say hi, if you could just type hi back, that'd be most greatly appreciated. And then I just know everything works. So when you do ask questions, I can answer them. Okay, so kind of UK tax, property tax that you need to be aware of. There's stamp duty, land tax, VAT, income tax, capital gains tax, and inheritance tax. I mean, crikey, O'Reilly, that's a lot of taxes to consider, isn't there, as a property investor? And the thing I will say is that I won't be addressing VAT on this webinar. I'm just going to focus on stamp duty, land tax, income tax, capital gains tax, and inheritance tax. And to be honest, that's quite a lot anyway, isn't it? So let's get into it and focus now on tax year ends and filings and key dates that you should note. Please note, throughout this webinar, you will see these QR codes. Take your picture so you can go straight to our website and use those QR codes for that. There are some free online tax calculators as well, and the website page is also at the bottom of each slide. So feel free to do that. You'll notice that there's a box on the top right-hand corner, even though I might be at the bottom left. And that's because when I repurpose this and put them onto snippets of videos on YouTube, I can put it in the correct place. There you go. Some technicalities that you probably didn't really want to know or care about. But hey ho. Oh, wow, I've got population data science at Swansea University. I'm honoured. Thank you ever so much for joining me. So let's go to key dates. So the tax year end and tax beginning for UK is the 6th of April to the 5th of April. So we start on the 6th of April 2024, and the year end will finish 5th of April 2025. A really strange one, especially when I do US taxes, and that follows a more principle-based system of calendar. Starts from 1st of January to the 31st of December. Much easier than 6th of April to 5th of April. But anyway, that's where we are for UK tax. Tax filing needs to be done by the 31st of January. And so please do not be late. There will be penalties and fines for not filing on time. And tax payments are two typically in the UK. So you normally pay your tax bill on the 31st of January, but the problem is with that, if HMRC give you an estimated tax for the next year as well, you have to pay your tax bill on the 31st of January. Then you have to pay 50% of your estimated tax bill by 31st January. So that's a kind of a 150% tax that you have to pay, because they're trying anyone that has a tax liability of £1,000, that's not going to be collected through PAYE. They will try and get you to start paying estimated taxes. And then the 31st of July is when you pay the second amount of estimated taxes. So they're getting taxed from you technically during the year, as opposed to when you do your tax return. But again, that can be managed. And that's called payments on account, just for your information on that one. Not many people are saying hi, actually. So, oh, good. Maybe your keyboards don't work, or you're watching by phone. Not thought about that. But you could type by phone, right? Not sure. Please do it. That'd be really good. Keeps my motivation high. Okay, we're going to focus on stamp duty land tax. So just a narrative, just to help everyone keep on page. So stamp duty land tax is a tax paid on property transactions in the United Kingdom. The amount depends on the purchase price of the property and whether you are a first-time buyer, because there are concessions for first-time buyers versus a person that has property already, or purchasing an additional property. And we'll talk about that a little later on. SDLT rates vary across different bands, with higher rates applicable for second homes and buy-to-let investments, which is what majority of you will be investing in. And you've got to be aware of these additional rates. And I'll talk about those a little later. Understanding SDLT is crucial for anyone buying residential or commercial property in the UK, as it impacts the overall cost of the transaction. It really, and one of the things I would say about property investing is that you do need to take into account all of the costs that comes with it to make sure that you understand things like return on investment, which I'm not going to be covering today. That's maybe a different webinar. If you're interested, I could talk about investment strategies or how to manage money and something like that. So if you've got some ideas of different kind of webinars I can run in the future as we go along tonight, then please feel free to drop a comment. That'd be really appreciated as well. Because if I can help me with some comments, I can help you by giving you even more content in the future. All right, so talk about banded and high rates of stamp duty land tax. So the banded rate does go from 0% to 12%, and we'll cover that in a bit more detail. There's the 3% additional property or limited company. You notice I say or limited company because if you have a property, it's a home in your name, and then you buy a buy-to-let in your own name, you pay the 3% additional 3% rate. But you always pay the 3% SDLT high rate, even if the limited company does not have property. It will always pay 3%, irrespective, for residential property. And then finally, there's the 2% rate as well. And the 2% foreign surcharge is for anyone that's not UK resident buying property in the UK will now face this 2%, which is a way of HMRC and the government trying to reduce the amount of external investors. Personally, I can't see that working anytime soon. 2% on a one-off cost versus an annual fee, it's not good to put people off. And in fact, I've got many international investors that do not really care too much about 2% because overall, it's still a better investment and safer investment in the UK than most other countries. Okay, so now we're going to focus on the stamp duty land tax banded rates. And you'll notice I've put in here residential versus non-res. And residential is a home. Non-residential is offices, restaurants, shops, that kind of thing. It's all non-residential. And there's a good reason why I put this on here. So when I get to the end of this, you might want to take a screenshot of this because it's quite good information. So there's two levels so far. You'll notice that I've got £40,000 to £250,000. And that's because those rates really kick in around about those rates, especially for the 3%. Now, the 2% is on the total price. The 0% is because it's below 250,000. Anyone that remembers that the SDLT banded rate was 0% up to £125,000. Most recent years, that's now 250,000. So you don't pay any stamp duty land tax on buying your home, for instance, up to £250,000. But if you're buying a buy-to-let, you'll pay 3%. And if you're a foreigner, then you pay an additional 2%. So 5% in total. But non-residential, while there's a 0% rate up to £150,000, you kind of think, well, that's not as good, is it? Well, you'll see that it is in a second, because residential property has a banded rate from £250,000 to £925,000, which is a 5% rate. Now, you will notice that the non-residential rate is £150,000 to £250,000 is 2%. So there's a banded there. You kind of think, well, you're paying surely more on non-residential than you're residential. Not so quick. And you'll see why in a second. And this is it. So properties up to 925,000 to 1.5 million. And please note that the non-residential does not have the 3% rate. It doesn't have the 2% rate for foreigners either. So it's just comparing the banded rate, which is the furthest left on the residential rates. But you don't get the 3%, you don't get the 2% in addition. So already you're saving money. Once you go over 925,000 to 1.5 million, you're paying 10%, sorry. And then it remains at 5% on non-residential. So that you're saving heck a lot of stamp duty land tax buying non-residential properties. So even if you add up the 10% plus the 3%, that's 13% versus 5%, which is substantially higher. And then if you're buying property at 1.5 million, I mean, I'm not sure anyone should be buying property at 1.5 million as an investment if they're trying to get return investment, or unless they're getting capital appreciation, then maybe 1.5 million in London might be a good idea. But here you're paying 12% on the banded rate, plus you've got your 3% SDLT high rate, and then if you're a foreigner as well, 2%. Please do just take a second, because there's no other numbers here, but please do note that the non-residential rate, the top rate is 5%. If you're not a foreigner in the UK, you're buying residential property, you're paying 15% at 1.5 million, 13% on 925. And most times, I don't see many people buying those kind of properties. I do see people buy properties between 300 and 500,000. That's typically the band I see. But that's still 5% plus the 3%. That's 8% on that band, compared to 5% on anything above in non-residential rates. So there's quite a lot of savings could be had on a certain strategy I'll share with you in a second. Stamp duty, mixed-use properties. Why am I talking about mixed-use properties? It's because there'll be an element of residential and non-residential. And because you've got that going on, then you could utilize the non-residential rates of stamp duty, which is really, really useful to save the 3% at least. So a flat above a shop or a restaurant. I see these a lot in city centres, whereby you have in Birmingham, London, any city to be fair, Nottingham as well, where you have shops, you have restaurants, you have maybe sometimes an office block with residential at the top as well. And you can save a lot of stamp duty because you've got mixed rates use. So that could be quite good. And of course, you do need to buy the shop and the flats. It's not the fact you're buying a flat and it just so happens to be above a shop. That doesn't work. That you're buying just a residential if you do that. So you do need to buy the block, as in the flat above and the restaurant, or whether it's a flat above with the shop. Home on land with offices, again, similar kind of thing. If you've got mixed use of offices with homes, and agricultural buildings. I mean, that's an interesting one if people are having grazing land, or they've got paddocks, or they're doing commercial rents and stuff like that. Quite a good way of reducing stamp duty. Now, there are a couple of court cases, again, take a shot at this. So people talk about uninhabitable properties and saying, well, it doesn't have running water, there's a few tiles missing, it's leaking through the roof, it can't be lived in. And there's been a couple of cases whereby, the Bewley case was a classic case where, hey, yep, the judge agreed that the property was uninhabitable, therefore you do not need to pay residential rates of SDLT, you pay non-residential rates, which saves straight away the 3%. But then this court case in 2023 went the other way around. It was like, oh, well, yeah, but it's restoration issues. It could be fixed. But that's pretty much the same issue that Bewley's had, and the judge really ignored that. So there's great conflict with court cases now in regards to stamp duty land tax, and there isn't a common theme, even though it's going to the top judges. There still doesn't seem to be a consistency in terms of how they're being treated. So people that want to go through the Bewley case saying my property is uninhabitable when buying it, you now need to think about Amajit at Mudon as well, whereby that went against the taxpayer, and the courts went with HMRC to say that it's a residential property and 3% should also apply. And my argument would be, well, actually, I don't think it should have done because of the Bewley case. But, that just goes to show you how court cases can vary significantly. All right, so I'm going to take a break. It's my first break. So if you've got any questions, feel free to ask away. I've got a lot of people saying hi, so it's good to see that. But if you do have any questions, Vass Associates Limited, hello. If you have any questions, feel free to ask those questions. I'm going to take a sip of water if that's okay, just because it's thirsty work. And I've got a Real Madrid cup, which you can't see, I don't think. But anyway, so let's have a look at your questions. What questions do you have? I haven't got any so far. That's shocking. Is this really bad content, or? Actually, can you see my Real Madrid top? There you go. There's my Real Madrid cup. Oh, by the way, I'm not a glory hunter. I'm not just there because of they keep winning every single trophy, by the way. Albeit I do live in Spain, so I could argue, it's more near Malaga, unfortunately, but I can't get away with supporting Real Madrid, really, can I? So let's get into the next. You haven't got any more. Oh, it makes sense so far. Thanks, James. Let's proceed in that case. All right, income tax. So this is the tax that is going to be chargeable on the profits you make on your profits, or property profits, I should say. But there is a definition I'd like to read to you. Income tax in the United Kingdom is levied on earnings from employment, self-employment, pensions, and most other types of income, including property, of course. The amount of tax is determined by income thresholds and rates that vary depending on the individual total earnings. And again, we have to remember it's a banded rate, so the more you earn, the more tax you pay, with allowances and reliefs available to reduce taxable income for certain groups. All right, so a bit of narrative for you. There's two main streams, really. If you think about what taxes do you pay, there's income tax, there's capital gains tax, and we'll cover that in another section of tonight's webinar. But then there's dividends income as well, and how much tax you pay for that. So we'll talk about all of those today. Right, so the tax-free amount, dividends used to be £2,000, if you remember, in fact, £5,000 once upon a time. Yes, the government likes to keep on taking, don't they? So we're down to £500 tax-free dividends maximum per year per person, but you do have a personal income allowance of £12,570. Interesting enough, that it depends on if you meet certain criteria, but there's additional £1,000 for self-employment and £1,000 for property income as well. But you've got to meet stringent requirements to get those amounts. Once you get over 12,571, then you pay 20% up to 50,270. Dividends goes up to 8.75% tax. So that's not too bad, you think. But actually, the company that you get the shares of the dividends from is already paid corporation tax either at 19%, 26.5%, or 25%. And we'll talk about that a little later on. So the 8.75% is still quite steep, in my opinion. Most countries give you a different allowance for that. the UK is very, very highly taxed at the minute. High tax rate, that's why I'm living in Spain. So there you go. Not to be smug, but I can't help myself. Right, moving on. Okay, so tax bands, high rate. So we've got 40% at £50,000, 270. And then you've got additional rate tax band at 125, 141, 45%. And then the dividend tax also follows through. Look at that dividend tax at 39.35% for additional rate tax base. That's on top of the 19% as a minimum corporation tax that's paid. So, you know, you're talking about 48% tax. Well, sorry, I should say, you're talking about more than 50% tax in overall, which most people will be paying. So, you know, straight away, you know, near enough 60%. But if companies are making significant profits of 25%, then you're talking near enough 70% profit tax by the time you look at all taxes considered, which just shows you how bad the UK is and how uncompetitive it is compared to a lot of other countries. Like Spain, for instance, is a top tax rate of 21%. America, 21%, albeit they do have state tax. Hong Kong, even less at 16% or thereabouts. So really the UK are falling behind, my view, and it's not going to get any better with the Labour Party, is it? So allowable costs to reduce property profits, what can you do? So professional services, so things like letting agents fees if they look after your property, if you've got anyone inspecting properties, that kind of thing, electricians, plumbers, all of that could be put into there, which also covers off repairs and maintenance. Now, I do want to stop on this thing because there is the 3 R's which you'll see, and this is actually come from HMRC rather than myself. Repairs, replace, and renew. And years ago, I used to live sessions in front of a few hundred people and talk about allowable costs against property. And I used to get people to sing that, repair, replace, renew, and get them to repeat it. And the reason why I did that, by the way, is to make sure that people remembered it. So that's why I'm repeating it to you right now. It's because I know repetition is good for remembrance. So repair, replace, renew. What does that mean? So let's break this down. If you're repairing something, then things like broken tiles, that's a repair. If you have got broken cabinetry that you're fixing in the kitchen, that's a repair, and that's 100% allowable to be offset against your rental income. What about replacement? Again, if you get a bathroom suite or a kitchen suite, then that will be replaceable as well, and therefore offset against your income. Renewals, I always use renewals as making things look nice. So painting, decorating, that kind of thing. And please note, I want to focus on this area because there's a couple of things to go through in my mind. Is what the HMRC say, it's got to be a like-for-like comparison. So if you're replacing 8 cabinets in a kitchen, for instance, with 8 cabinets, then that's like-for-like. That's totally fine. And you could argue, well, actually, I've got 10 cabinets instead of 8. Is that likely to cause issues? Probably not. But if you're going to go from a single-let property to a HMO, and then you're knocking walls out and you're making 2 rooms into a dining area plus a kitchen area, and you've got lots more cabinets going in there, and it's a little bit more modern space provided, then actually it may not be allowable against your income. And you might think, well, how will HMRC know? And that's a good question. But most people I've noticed like to put their pictures on Facebook. I wonder if HMRC are ever on Facebook. I'll let you think about that. But yeah, so anything that goes into repair, replace, renewal, if it's like for like, then it'll be offset against your income. Interest on loans, so I'm talking about mortgages, of course, but you can have loans as well where interest will be on there. Does it offset your property profits? Well, to a degree, yes, but we need to think about Section 24, mortgage interest relief cap. And again, we'll cover that off in a little while. Office costs. So if you're running an office and you've got a room in your home that you use for an office, and you're using electricity, broadband, or something like that, you can put a notional fee against there. We always say to our clients it's about £312 per year. Not a great deal, I have to be honest, but that's the safest option. I think HMRC give you £4-6 per week rate that you can utilise. There's a variable rate as well, but a bit more technical for tonight's webinar, I would say. Travel. This is probably one of the most problematic expenses in a way, because people say, well, should I have a company car? And I always say no, because the benefit in kind charge is ridiculous. And so you're better to put in mileage. Now, the problem is with mileage that people forget. And if you're looking at a property to buy, that is a genuine cost of running your business. You can put that in. If you're seeing an estate agent, a letting agent, that travel from your home to their offices will be allowable. If you're going to see your property for inspection or to see the property from the first time or seeing tenants, then those costs will be allowable. And you just need to keep a logbook of the dates you go and see them and the mileage that you've done. And then, of course, you've got networking events as well. This is a webinar, but you might be going to networking events in general, and those travel expenses will also be allowed. So now we're going to focus on section 24. I do see some questions coming through. They come in a little bit later while I'm on this, so I will come back to the stamp duty questions in a little while. Section 24, tax on property profits. And I've got two columns here, financials and tax at 40%. So I'm focusing on the high rate taxpayers because section 24 does not affect basic rate taxpayers. And why is that? Well, first of all, you get a 20% tax reducer on the mortgage interest costs as a landlord. Doesn't matter what tax bracket you're in. But if a basic rate taxpayer, that's 20%. Well, hold on a minute. I'm not getting my 20% tax reduction on mortgage interest, but I'm getting this 20% tax reducer. Same thing, isn't it? Well, yes, actually, it is. So for basic rate taxpayers, section 24 does not affect you. But high rate taxpayers, additional rate taxpayers, then section 24 clearly does. And that's why I like to focus on just high rate taxpayers. But if you're a basic rate taxpayer, hey, it doesn't affect you. Please don't fall asleep. There'll be other things that we can talk about. Okay, so we've got property gross profit of 10,000. You'll have a tax liability of 4,000. What I mean by gross profit, by the way, I'm talking about the rent, less any letting agency fees, less the repairs and maintenance and so on like that. So we talk about really bottom line-ish, but of course we've got mortgage interest, so that's why I call it gross profit. Then we've got £5,000 worth of mortgage interest costs. So straight away you're looking at £10,000 gross profit, less the £5,000 mortgage interest. But please do note that you only get a 20% tax relief on that 5,000, which is £1,000 here. So really, it's not the 2,000 that you ordinarily would have got before Section 24 came into effect, and that really is rubbing salt into the wound. Net profit and net tax is £5,000 on the financials. So gross profit, again, all the expenses already coming out to get you that gross profit line. Mortgage interest and gives you net profit of 5,000. That's the real profit. Now, what's happening here is that the tax position is £3,000, and that's because you got £4,000 tax on the 10,000, ignoring mortgage interest, less the 20% tax relief, which gives you then £3,000. So gross profit is 50%, but your tax rate is 60%. So even as a high rate taxpayer, you're thinking, well, my tax rate is only going to be 4%. Surely I only pay 40% tax. And the answer to that is, well, no, not at all. Actually, we have clients that are, I remember one client that had a tax bill of 135%. That was hurtful, right? So 135%. So whatever profits he was making, he was giving 35%. So all of the profits was going to HMRC, plus an additional out of their own pocket, an extra 35% was going to HMRC. Well, I just think that's criminal. That's borderline theft. The fact that you can tax someone higher than the earnings that they get, that's just criminal in my view. But then we are talking about a corrupt government, aren't we? In many ways, gambling on their own results. I mean, I don't know if anyone could be any more corrupt than what we're seeing now at the minute, But anyway, this is not political. This is definitely a tax seminar, so I will rein it in. But in terms of 6% profits, so 6% tax on your profits, that's substantial, isn't it? And that's why people are leaving the marketplace, because they're paying a lot of tax like this. How to reduce income tax on property profits? Use your spouse. If you're in a married couple situation and your spouse is not working, or they're in a basic rate tax job and you're in a high rate tax job, then give the property profits to them. You can do that by deed of trust, quite easy. There are a few hoops that you've got to go through, but that's definitely one strategy that we've utilized for many, many years, in all honesty. So that's definitely one. Second thing is buy property and refurb. I mean, I did this for 20 odd years, wasn't it? That's ridiculous. No, I did this for at least 8 years, so straight, where what I would do is buy property. And then when my tax was going to be hitting my property profits, I would buy another property and then spend another £15,000–20,000 worth of refurb on that, plus maintenance of the other properties. So I would have always been a loss-making position, so I would never pay tax. So you could do that yourself. I mean, I did that for 8 years straight, and then I moved my properties into a company, and then that was that job done. So you could do the same, really. If you've got properties in your name, then buy properties, keep on buying, get the refurb, and eventually it's going to bite you at some stage. But you've got a new strategy then of giving up a job, for instance. Pension contributions. Pension contributions is a classic. Salary sacrifice if you're working in a corporate job, or any job to be fair. But if you're in a job that allows you to make pension contributions through salary sacrifice, then that's a great way of reducing your overall employment income and overall taxable income, which means you'll pay less tax. And Section 24 may not hurt you if you go from a high rate tax band position to a basic rate tax band position. So that's definitely a couple of ways of reducing income tax. All right, I did say I will get back to some of your questions. So if you've got any questions on the income tax side of things, then feel free. I'm going to go over to see if I can see some of the screens. Yeah, I can actually see it better on my screen. I don't think this now. Okay, so how is first-time buyer defined? First-time buyer is someone who's not had a property before. So pretty nice and easy question. Thank you very much for that. Gets me to the stride, doesn't it? Give me easy questions. Portfolio at 917 is not going to be so helpful. It's going to give me some difficult questions. So I'm a landlord and want to know, if I sell my residential home and buy a new residential home, do I have to pay the high rate of SDLT? And that's a good question. So anyone who has got a home and you're replacing that home with a new home, then you don't have to pay the 3% SDLT high rate. In addition, you could be in a position whereby you buy a new home, you pay the 3%, and then eventually, well, not eventually, but within about a year, you sell your current home, you can actually claim back the 3%. So it's not the be all and end all of having to sell your home at or the same time or just before you buy a new home, which is normal play, to be fair. But if you get stuck with your home, then you do have an opportunity to claim back. Oh gosh, what's happened to my teeth? Claim back the 3% SDLT high rate. Let me just have a quick drink of this. And I promise you that I won't gargle. That would not be too good on a webinar like this. Gargling away. Oh dear. So yes, that hopefully answers that question. VAS Associates, sale of main residential home and buying another one, having other buy-to-let properties at the same time. How stamp duty works for a new residential home. Hopefully I've explained that one. So that should be all right. How does Section 24 not affect basic rate taxpayers? Because, James, that you get a 20% tax reducer on the mortgage interest, irrespective of what spend you're in. Now, a basic rate taxpayer is paying 20%, so they're not losing because they're getting the same tax relief anyway. So that's why it was always aimed at high rate taxpayers. Yeah, those horrible people earning money, huh? How dare they? Right, so Rob, can you move the money on your UK limited company to Spain and then pay only 20%? Can you, hold on a sec. Can you move the money on your UK limited company to Spain? Okay, well, to be fair, if you are a Spanish resident, tax resident like me, you do have to pay income tax in Spain on those dividends. So it's not quite as clear cut as you would like it to be, given what you've just said. But you could go to some countries and not pay any tax on your dividends, like Hong Kong, for instance. If you're living in Hong Kong or other Asian countries, then you may not have to pay any income tax on those dividends. There you go. All right, so let's just see on my iPad if it's caught up with my questions. So it has, so hopefully you like it. If you haven't pressed the like button yet, please do so. That would be fantastic. Just so, and if you want to share the link as well of this video so other people can learn as well, if you find it useful, then please do share with your friends as well. All right, let's move on. Capital gains tax, nice and easy. So capital gains tax, oh boy. In the United Kingdom, capital gains tax is levied on the profit made from selling assets, including residential property. The rate for CGT on residential property differs depending on whether the property is classified as a primary residence or an investment property. Okay, so typically you don't pay, if you have a home and you sell your home, then you don't pay capital gains tax because you get your residence relief, which you don't get in Spain. Ouch. That's another problem I've got. So generally, higher CGT rates. It's not all great living in Spain, you know. So generally, higher CGT rates apply to gains from the sale of second homes, buy-to-let properties, or other investment properties compared to those applied to gains on the sale of a primary residence. Now, let's just try and get some numbers around this. So let's have a look at an example here, selling a residential property. Sales value of £200,000. Purchase cost of £150,000. And please note, when I talk about sales value, you also have to take into account any fees that you've paid out to the estate agent, to your letting agent, to your whoever, where you've not deducted it from your rental income. So that would go against your sales of getting rid of the property because it might have been left empty for some period of time. Purchase costs, again, some of the mistakes I see is not including stamp duty and land tax. Now here, £150,000, you wouldn't have any unless it's a 3%, of course. And then you've got the fees for the solicitor as well. But anyway, there's your gain at 50,000. And then I've put here less exemptions and losses. So exemptions, everyone does get an annual exemption. And there may be also losses that you've had from prior years that you could offset against the gain in this year. Please do note, a common question I get is, well, my property's been mortgaged and my mortgage is 170,000. Surely it's the difference between 200,000 and 170,000. No, it ignores debt. That may be useful for inheritance tax, but when it comes to capital gains tax, it looks at the sales less the purchase cost of the property to get the gain. So that's why I think it's always useful for me to repeat that process. CGT rates. I'm going to be comparing 6th of April 2023 to 6th of April 2024. Tax-free allowance was reduced from £6,000 to £3,000. Now, for a couple, that does double, of course. So remember the days that you get £12,000 exemptions? Gone. Shocking. Basic rate taxpayer. So you'll notice that here, a basic rate taxpayer earning up to circa £50,000 will pay CGT of 10%, selling non-residential property. So commercial property could come into that. Stock shares could come into that. So those rates haven't really changed. But what has changed is the high rate tax band for residential properties. So again, high rate taxpayer selling commercial property or shares pays 20%. Okay. And on that point, if they're selling a residential property, it used to be 20%, now it's down to 24%. And people were saying, oh, how generous are the government to do that? Well, it's not really generous at all. I mean, the idea behind it is to bring properties back onto the market for those people to be buying them as homes. That's the mantra. If we break this down, it just shows you how incompetent the government has been for many, many years. Because you would kind of argue and say, well, why don't you bring CGT down to 16% or 14%, not 24%? If you're trying to get more homes onto the market, why are you charging 24%? It's counterintuitive. I mean, it's pretty dense, right? But they're saying, well, we gave you this £3,000 tax-free the tax-free allowance was reduced by 3,000 as well. But hey, we did give you a discount of 4% on the high rate taxpayer. Didn't really work out, does it? I mean, you're still paying a lot more because you lose your tax-free allowance. So again, just crazy. And I don't understand the government one iota. It'd be interesting to see if you do. I can't imagine what the Labour Party would be like as well. So capital gains tax, how to reduce it. Use spouse lower tax band. Again, if you've got a spouse, you can do a deed of trust just before you sell the property. You might have to do some jiggery-pokery in terms of what percentage they should get, because you don't want them to lose the annual allowance. We've got a good capital gains tax calculator, funny enough, on our website. But if you want to get really specific about what percentage should be allocated to the basic rate taxpayer versus high rate taxpayer, then it will be a tax consultation, and we can certainly sort you out with that. But again, it's a missed opportunity. Most people don't use their basic rate tax band, or they don't have the property in both names, which means they don't have CGT annual exemptions. They just have an annual exemption, singular, not plural. Offset losses against gains. Sometimes, if you're in a position whereby you've got some stocks and you just think, well, actually, should I just get rid of them because I've got property profits? If I have a gain and I've got losses, well, actually, I could reduce those profits or those gains on my property, and therefore I pay less tax. It makes a lot of sense. So sometimes selling some assets that you just think that might not ever increase in value, get rid of it, and then use the cash for something more useful. I'm not going to go into this with any great detail, but you could invest in EIS, SEIS, and VCT's investments. I can't talk about them at large, simply because they are a financial product, and then you need to work with a financial planner or financial advisor who is regulated by the FCA. I am not, so I can't talk about it, but I can tell you that it can reduce CGT quite nicely. Thank you. And indeed, it could help you reduce income tax all at the same time. All right, so that was a bit of a quick tour around capital gains tax. So let's have a look to see what questions have come through this time around. So in fact, what I might do, see if this works, because I've always messed this up in the past. Can I do this as show? Can I do that? Oh, look at that. Okay, that's good, isn't it? I can bring the questions online as well. So if I turn Resi Home to buy to let and then buy a new residential home, what percentage would be my SDLT be? Well, if you transfer a residential home to a buy to let, you've still got a property already in your name. So if you buy a residential property as a home, you are still having a second home. The fact that you converted it matters not. You've still got a second property in your name, so it doesn't work. However, I don't like to be too negative, but what you can do is transfer that property to a limited company. And we work with a lot of clients to really work out whether it's worth it or not to move a property to a limited company, and how that works for the short term and the long term. And that could be a quite good tax consultation to have with us, just to understand, okay, what's the overall picture of my tax liabilities, not just stamp duty, land tax, but all taxes, and then to see if it makes sense to move it over to a company. It can be quite complex because you've got to think of different factors, but it is also a consideration to have. All right, so there you go. Thank you for that question. Portfolio at N17. All right, so N17. I know a couple of clients that way. So let's think. Move on. Let's move on. Limited companies. I mean, what a big thing this is now, isn't it? Limited company. If a landlord is new, they don't often buy properties in their own names. They're buying it in a limited company. It seems to be a growing trend, probably the only trend. Limited companies, using a UK limited company for tax purposes can provide advantages. Well, why else would you do it? Such as lower corporation tax rates and limited liability protection for shareholders. I'm saying that because I do know some accountants that say, oh, you should use a limited company per property and just push up our fees for managing those limited companies for you. And I just feel that's really criminal. Anyway, however, it involves stricter regulatory compliance and administrative responsibilities compared to filing personal self-assessments. Indeed, it does, which is simpler but may result in higher personal tax liabilities depending on income levels and allowances. Choosing between the two depends on individual circumstances, long-term business objectives. And of course, using a limited company has its pros and cons. And some of the tax consultations I do is to go through those for the short, medium, and long term. Because again, most accountants would say, yes, short term, this makes complete sense. And then forgetting long term, you have other plans. And then they negate that and then give you the wrong tax advice. So you always have to be careful with that. Structures for limited companies, you have directors and you have shareholders. They are two different things. You can be both, you can be one. So you can have a company where it has a director, but they're not a shareholder. You can have a company, shareholders, not directors. You can, of course, have the other version of directors and shareholders. Well, you could actually have the fourth, couldn't you? You could actually not be a director, not a shareholder at all, and just be a stakeholder of all of the type. But anyway, I'm probably boring you to death with that. So tax on property profits. Let's go through this. So remember, in your own name, I'm just going to riddle through this. So there you go. The problem we have having property in our own name is that 60% tax liability. We've already covered this off, but I wanted to bring it up again because we want to look at corporation tax. Now, if you've got profits of £50,000, then corporation tax rate is 19% in 2022, 23, 24 as well, for that matter. And I think the reason why I put that is because of the change came into effect at that 2023, whereby the corporation tax rates changed. So anyone making profits between £50,000 and £250,000 will pay an effective tax rate of 26.5%. It's not, there's no real kind of number in HMRCs that say it's 26.5%, but if you do the calculations, it's an effective tax rate, which basically means you're paying more tax. Once you have profits over £250,000, then you're straight into, sorry, the last band is 7.5% increase. So 26.5% minus 19 is an additional 7.5% tax, which is £15,000 per day. Now, if you've got profits of more than £250,000, then you pay straight away 25% corporation tax, which is phenomenal, isn't it? I mean, it's just kind of think, well, how is the government, again, I just don't want to be picking fault with the government, but it is all their fault. How are they incentivizing business to come in? I mean, both governments have said, oh, we're not going to stop investments in. Well, clearly you are, because you're just so anti-competitive when it comes to corporation tax rates. 25%, it's just crazy. Which is an extra 6% of what it was the year before when they charged 19%. Now, what I want to do for you here is also give you this remit of how much dividends, you have a limited company, but then you obviously have dividends coming out of the limited company. And how much can you earn tax-free? And again, it used to be 2,000, it used to be 5,000, but 2,000, 1,000, now £500 tax-free dividends. That's it. It's not worth it, really, is it? Then you've got a basic rate tax band. It used to be 7.5%. They've increased that to 8.75. So people earning up to £50,000. High rate tax bands, 32.5%, 33.75% now. And then additional rate taxpayers move from 38.1% to 39.35%. So they're getting more tax on the company, but also they're now charging you greater income tax on those dividends that you pull out the limited company. And they're just killing business, in my opinion. Associated limited company rules. Something else that the government did, and this is a bit of a stealth tax, and it's something that many people don't understand and don't understand the impact. And I really want you to just take the time here, because if you are a kind of person right now that has multiple limited companies, I want you to think about, should you get rid of them? Okay, I've hopefully got that train of thought in your mind. Associated companies refers to entities, companies, that have more than one company. So if you have more than one company, then you have to that are closely connected through share control or ownership. So if you own 3 companies, they are all associated by nature because you own all 3. Issues may arise regarding transfer pricing, group relief, and the application of anti-avoidance rules, which aim to ensure for fair taxation and prevent profits shifting amongst associated companies. So what people were doing, and this would be a typical example of furnished holiday lets or people that were getting towards the 85% before for VAT. And what they used to do is set up another company and then say, well, that company makes £70,000 worth of turnover. This company makes £60,000, therefore not VAT registered. But actually, when you group them together, it's actually a lot more. It's over the VAT threshold. Therefore, this new associated company rules means that, hey, you own both of those companies. Both of them should be VAT registered. Okay. I still see accountants still say that to clients, say, well, just split your income up. It's like, what plan are you on? It's just never been a thing. But we do get clients coming to us in a whole host of mess that other accountants have created, just simply because they're not keeping on top of changes in legislation. They're probably back in the 30, 40 years. They should retire. Anyway, I feel like I'm on a high horse today. I should calm it down. Where's my volume? Volume, anyone? Right. No, I can't see any volume. Okay, corporation tax. My mum's still got those, apparently. Don't tell her. So corporation tax and associated limited companies. So this is a classic example of 3 different examples. One person got 1 company, another person's got 3 companies, and another person's got 5 companies. All right, so straight away, the 19% tax band. You might have recalled that I said profits up to £50,000 would be subject to 19%. But actually, if you've got 3 companies, you had to divide that 50,000 by the 3 companies. So each company now only has a band up to 16,667 each before it pays higher rates of tax than 90%. Now you might argue and say, well, actually, I've got 2 companies that are making a loss and only 1 company that makes a profit. Does that change anything? No, because they're still active. They are still trading. So those loss-making companies are actually going to hurt you even more, and certainly going to be hurting the company that's making a good profit. So you have to question, should you keep that company or get rid of it? Someone with 5 companies, we have clients that got 10, 12 companies. I'm constantly telling them to get rid of them. I mean, you kind of think, well, you're not a very good salesperson, Simon, because if you're an accountant, surely you should be adding up the dollars, how many companies they've got. But actually, I don't. I tend to look at the clients and look and say, you're in a mess because you've got too many companies. Imagine your wallet and having 12 companies. You've got 12 cards for companies. Your wallet's going to be huge, right? I mean, just that in itself is an administrative nightmare. You got 12 bookkeeping systems to look after. It's just, wow, not for me. But the associated company rule certainly hurts you. You've got 5 companies. You don't have a £50,000 tax ban. You have a £10,000 tax ban. And again, if some of those companies are making losses, then it's going to hurt you because the ones that are making more than 10,000 will be paying more than 19% corporation tax. Ouch. And the same applies to the 25% tax band. 1 company, £250,000, not a problem. Look at that one with 5 companies, only £50,000 of band before you hit the 25% tax rate. That's phenomenal. And again, that just goes back to our point of anyone that's got multiple companies really should look closely and get rid of them. Ways to extract cash from a limited company. I mean, taking wages, it can be useful, especially if you're not earning from other employment. If you are working elsewhere, please do not take wages out of your company. You have to pay emergency tax, technically speaking, and national insurance as well. So don't do it. But if you're not earning from somewhere else and you have a limited company, then take tax-free wages. I typically say anything between £6,000 because then you don't have to reuse payroll. 9,000, 9,500, then you don't pay national insurance, but you can go up to 12,570, and that's your base, your personal allowance. Dividends. You can take dividends out of a company, of course, but it does not reduce corporation tax like wages do. Interest and loans. If you've loaned your company money, then you can charge interest on that money, and some of that interest will be tax-free to you, and it still will reduce the corporation tax liability. So that can be quite a good trick to use. Again, do get consultation before you do that, because there are certain things you've got to use CT61 forms. Not easy, and you've got to really understand what you're doing with those things. Pension contributions. Again, if you have a limited company, putting money into a pension, I'll come on to that in a little while, but very, very good tax plan. And then vouchers. Your company can give you vouchers to do shopping, right? Another way of reducing tax. By the way, if you're looking at this thinking, well, I'm not sure what this really means, make sure that you speak to your accountant. If you haven't got an accountant, book some time with us and we could do a tax consultation to go through all of this to talk about your specific needs. Taking pensions, of course, the pension allowance is now 60,000, so you could put money straight into a pension and reduce your profits. So reduce the corporation tax, of course we know, but it also reduces IHT. Why? Because if you've got a company, that company will be subject to inheritance tax when you die. But if you put the money from your company, therefore reducing its net assets, and put it into a pension which is outside of your estate, therefore you do not pay inheritance tax on it. So it's a really cool move to put money towards a pension. All right, so there you are. Let's take some questions. There's a few. In fact, I'm not going to use that. I'm going to use something different, actually. Let's just have a look. Let's just share the questions there. Here we go. New technology. So James has asked a question, can you claim 20% under Section 24? Yes, if you're a basic rate taxpayer, but the mortgage stays in your spouse's name. You have done a deed of trust to move your property over. Well, the way I always look at that is, however you've done the deed of trust, so the property income, you've got to know that the costs follow. So and this works, you've got to think about this from a sense of, if I'm a guarantor for someone and I'm just saying I will be responsible for that mortgage if things go wrong, but my son, for example, has a property and he wants a mortgage, there you are, that mortgage interest cost will still go against the rental income. So just because I'm the guarantor, that's what you are, technically speaking, where the mortgage stays in you, but actually the debt and the interest associated with that debt does go over. And anyone worrying about that should go to HMRC HS 340, which tells you more about how you can transfer the mortgage interest costs for a particular business. There you are. Great question, James. I've only got 2 questions. I can't believe it. Are the investment company's property considered an associated company with other trading companies? We have to remember here, VAS Associates Limited, that the trade company and investments company are part of you. So it is you that makes these companies associated, not what they do. So they can be completely independent of one another, but if you own them, you control them, then they can associate it because of you. So hopefully that makes sense. Yeah, it's a quite difficult one to get around your head on that one, isn't it? But yeah. Okay, so wow, I'm surprised I've run over time and I'm still going strong. So please do bear with me. Inheritance tax, last subject, I think. Inheritance tax, we're covered now. In the United Kingdom, inheritance tax is a tax on the estate of someone who has died, including their property, money, and possessions, not pensions. It is typically paid if the value of the estate exceeds a certain threshold, which we will go to in a second, with exemptions and reliefs available for spouses, charities, and some types of business assets. And business types of assets, I'm talking about trade businesses that continues on after that person has died. So something like our firm, Optimize, hopefully this will continue when I'm gone, and then my son will inherit this business but won't pay inheritance tax because he's continuing on. All right, so let's just talk about the basics though. So basic allowance, £325,000, which is net assets, please note. So if you have a property that's worth £500,000, and you have a mortgage on it for £300,000, then you're left with £200,000, which is below the IHT3 amount. Therefore, you do not pay any inheritance tax because it's below that 325. So this is based on net assets, not gross assets. Okay, really important. The IHT3 allowance will also double in a couple civil relationships as well. So £650,000 for a couple versus 325 as a single person. Residential nil rate band. You'll notice I've got stars on those. So you get £125,000, which is an additional amount to £325,000. It's a little bit tricky, so I'm not going to go too much detail on there. But if you've got a home that exceeds 325 and a few other things to think about as well, then you can get this extra allowance. So tax-free allowance, potentially, if you play your cards right, could be £500,000 for a single person and £1 million for a couple. And I'll come on to that star in a second. The excess rate above that, though, will be subject to 40%, which is phenomenal. When people talk about building wealth and then they forget about inheritance tax and then give it all away again, that isn't really careful planning, in my view. All right, so here's two examples. One person is single. A second example is a couple. So here we've got assets of £350,000 for the single person. The couple have got a net asset value of £3 million. Again, please do note that we're looking at net assets. So looking at gross asset value less any debts gives you net asset value, and that's what we're looking at here. So they got £3 million. Why has that got star next to it? And that's because the allowances that they get. You remember the single person gets the 325 plus the 175 for residential. You know, looking at that potentially, then they could get £500,000 allowance in total. Now you could argue, well, the assets don't agree to that, but you know, just bear with me a second. The reason why I'm comparing it though is because they get that allowance, which means that the single person pays no inheritance tax. But the allowance could be up to 500,000 because the net assets is not over 2 million. So once it goes over 2 million, then you lose your 175 residential nil rate band. That's why this couple have only got a £650,000 allowance, 325 times by 2, which is pretty much close to the single person, isn't it? If you look at it, it's not much difference. But that's because they lose the residential nil rate band. It's quite painful. Means that they've got 2.3 million taxable, and tax is now £940,000. Ouch, ouch, and ouch, 940,000 times. How to reduce it? Make gifts within 7 years of death. I've got a few videos coming up about that actually on YouTube. So if you're in a position, not that you know you're going to die in 7 years, no one knows that really, do we? But you should be making gifts as you get older is the idea. And if you make gifts of your assets, live for 7 years, then they come out of your estate and they're not subject to inheritance tax. Nice. Trade versus investment. Again, if you have a trade, like our service is professional services, so property developers come into that as well, are professional service deliveries, and then they don't fall into, well, there is a relief that you can get for business asset rollover relief versus investments you can't. So if you have property portfolio, it's considered investment and therefore do not get any IHT release whatsoever. If you've got agriculture, then you can get some release on as well. Leave the country, do what I do, say stuff off HMRC, not having my money, no way. And you can keep your clouds, to be quite honest. I'm sick and tired of your umbrellas. Umbrellas and tax, I don't want either of them. So, nah, bugger that. I'm off to Spain, and that's where I am, so thank you very much. All right, so ask and you shall receive. So I think that's pretty much the segment before I finish off for tonight. So here I am again. So let's have a look at the questions that come in. I'm not sure what I'm looking at iPad for. I already realized that my new system does it all for me. Brilliant. So let's see what questions have come in. Questions come in. Is pension investments limited? Pension investment limited to salary earnings for that year? No. If you've got pension investments, limited. Not sure what that means. Help me out with that, Vast Associates. If you're thinking about, I'm making pension contribution, should I take salary? Then yes, technically speaking. but I do see people that have made pension contributions and are exceeding their salary, if that makes sense. So yeah, hopefully that does answer that question. All right, so thank you ever so much for that tonight. Hopefully that's been useful. If you could press the like button again, I'm going to have a look at the like buttons. I've only got eight likes. Are you? Come on, guys. Am I really that rubbish? You stayed with me all this time, and I've got 8 likes. That's shocking. So yes, there you are. So let me just hide that. So thank you very much for tonight, for attending. Hopefully you found it useful. Book a tax consultation with us if you want to go to deep dive about your individual subjects. Otherwise, I will be doing some more. I think I've got another one talk about US taxes coming up, and I will be doing another property investment live session again in probably 3-4 weeks time with one of my clients. So hopefully you'll stick around and do that. So thank you ever so much for tonight, and I'll see you all again soon, and have a great evening.